Philip Tays, let me begin with you. We are either in correction, if you look at the NASDAQ, or correction-ish with respect to both the Dow and the S&P 500. You think we've got farther to go, that we're headed to a 20% or greater decline bear market territory. The bull market, in your view, is about to be over.
That's right, Tyler. And so there are these challenges that we can see right in front of us, right, which are the invasion of Kuwait, or beginning of an invasion into Kuwait, and potential for rising interest rates and inflation. But the thing that we look at more than anything that tends to be predictive is the history of what happens when you're where you are with valuations. And at 22 times trailing on the S&P 500, since 1900, we've only been above 20 times earnings 9 times. 7 of those times led to bear markets that averaged 42% with durations of 2.5 years. So that's the primary predictive thing. And then when you have all these other challenges, which is, one of the main things that we look at, and Kelly wrote about this yesterday, I saw, is that the Fed put is probably kaput, at least as it pertains to the stock market. So I think we probably have further to go down now, and I think that investors should look to potentially de-risk.
All right, let's go. We'll come back to that and how to do it in just a moment, and bring Kelly in to defend herself, her position here. Let's go to Scott Wren, though, and would you, Scott, particularly address Philip's point about valuations, that trailing valuations are at a level we are rarely at and usually presage a bear market?
Well, Ty, certainly stocks aren't cheap. And if you look at our number for this year, let's say $235, you're talking a 19 or 20 times multiple, something like that. We know that inflation has been high. Interest rates remain low, and they're going to probably go up just a little bit. But in our opinion, there's a lot of underinvestment out there. There's a lot of catch up that the rest of the world has to do. In other words, the U.S. has led the charge out of this recession, and Europe has lagged. Japan has lagged to a certain extent as well. China's having a few issues, but we expect global economic growth to be more synchronized. We think that the labor market is going to continue to improve. The labor force participation rate is going to continue to rise. So we're positive on consumer spending. We think that's going to drive the U.S. economy. There's a lot of companies out there right now that are spending money not on your traditional equipment, but they're spending money on efficiency technology, on automation technology. So we're going to see a little bit of business capital spending as well. Mm-hmm. And I think one of the main reasons is, inflation is really high right now, but what's going to happen over the next 12 to 24 months? In our opinion, it's going to decelerate this year relative to last year. And then it's in all likelihood in 23 versus 22 as well. So we think there's a number of positives out there, and we've been buyers on this dip.